3 months ago, we predicted that the performance of the large Nordic banks was at or near its peak, and today it looks like we were right. In Q4, we saw declining results. Due to lower income and higher expenses, the average return on equity of the banks fell to 14% from 15.9%, and the cost-to-income ratio increased to 41% from 36%. Now, these are still solid numbers, and the banks are well on track to meet their long-term financial goals. At the same time, this is a moment to note that the unprecedented boost to the bank's profitability we have seen over the last 18 months because of the rising interest rates is over, and we can expect a more normalized business environment from now on. For full year 23, the large Nordic banks delivered an average return on equity of 15%, up from 10%, and a cost-to-income ratio of 39%, down from 50%. These are remarkable improvements within a time span of only 1 year, and hence we wanted to put them into perspective and looked at the bank performance over the past decade. Now, there are a couple of major observations we can make based on this data. First of all, before last year, the income growth of the large Nordic banks was almost exactly the same as lending growth. And this tells us that the banks are predominantly engaged in traditional, low-risk retail banking business that is highly sensitive to the interest rate environment. So we can say that as the interest rate goes, so goes Nordic banking too. The other observation is that it seems that we can establish a ceiling for the bank profitability and efficiency. For profitability, that is a return on equity of around 10–11%. And for cost efficiency, it is a cost-to-income ratio of just below 50. Now, this might sound a bit discouraging. Is this all we can expect from the Nordic banks? But then we have to remember that the past decade, in terms of the economic environment, is the anomaly. A low interest rate, even a negative interest rate environment, is not the norm, it is the exception. And right now, with the central bank policy rates in the Nordics at around 4%, we're back to the norm. So that is the upside for the Nordic banks. On the downside, we see three main headwinds in 24 that the banks will have to deal with. Lower interest margins, higher expense levels, and growing loan losses. We have already seen first two of these forces picking up, and should the Nordic economies continue to weaken, we might begin to see also rising loan losses. Now, to be able to deal with this, the banks need to keep high focus on their cost discipline, to be able to avoid a situation where they have to make sacrifices with their long-term development needs. Now, this might not always be possible, and the banks need to face some tough decisions. To do this effectively, they need to have enterprise-wide portfolio management functions that can make these decisions based on the bank's long-term strategic needs. This is the only way for the banks to stay true to their long-term vision while executing on short-term tactical moves.